All right, this is the one you're here for. So we are going to be talking about the power of Fibonacci. How many of you guys use Fibonacci already in your trading? Sort of. I love the sort of answers. All right, well, I'm going to show you guys some really simple tips to how to use it just to improve your timing on your entries and your exits and give you a bit of clues as to how to look for alternative exits and entries in certain situations. So this is going to be a class that's going to be aimed for new to intermediate traders. Those of you that have been trading for quite a while, like I have though, hopefully you will still pick up some extra little tips that you can go and apply to your trading as we head into next week. I like to use a combination of trades that I've taken over the years as well as the most current market action because I want you guys to understand that the tools and techniques that I use in my own trading, they are going to be tools and techniques that are basically timeless. So I've been trading for over 20 years now, full-time. Had a little bit of a medical break in there for about 2 years in the middle, but other than that, full-time for 20 years. So one of the first things you're going to notice is that I like to keep things simple. I don't use a lot of indicators. So when I'm helping other traders learn to trade and just get the feel for the market, I use Fibonacci, and it's one of the few that I do use. So I want to share with you guys today the power of Fibonacci. So first things first, guys, do not trade with your children's college savings fund. No bueno. Just going to get that out of the way there. So let's talk about the art of analysis. So a lot of you that have known me for quite a while, you know that I come from a background in the arts. I grew up as an artist. I was trained as an artist from a very young age. And I went into archaeology originally, coming out of school, actually even before I was out of school. And so a lot of the things that I brought to the market, they're really based upon training that I've had for years. But what that has done is that it's made me very attuned to picking up patterns that are forming in the market. And so what I want to share with you are some of those patterns that I have noticed over time. So when we look at drawings, one of the first things you're going to notice is that how many of you are familiar with typical like bust images like this, right? You're looking at a human face head on, and then you're looking at it at a lot of different angles. Well, patterns in the market, they form the same way. So something might look like that textbook image right smack in the middle there. But when you're looking at it from different viewpoints, different vantage points, things can shift a little bit. And this is where things start to get trickier for people in the markets. So we're going to look at a couple of tools that can help provide a little bit of clarity to that. And we're going to work those in together here throughout today's session. So a little bit of background on Fibonacci. So the Fibonacci sequence, this is just a series of numbers where each new number is the sum of the previous two numbers. Very simple. 1 plus 2 is 3, 2 plus 3 is 5, so on and so forth. Not going to get too much into the background history of Fibonacci, but what you're going to find is that whether you believe in the validity of Fibonacci in nature and how much it applies to us as human beings, it is really hard to disclaim that Fibonacci works in the markets. I will even draw Fibonacci based upon an impulse move in the market, basically a primary trend in the market. And that happens intraday, and then I forget that I drew it. And I come back to the security like weeks later, and even though the market's trading nowhere near where it had been at that time, the levels will still continue to hold. So it is quite interesting. There's a lot of leeway and give for how you draw Fibonacci and still have it work and show you guys support and resistance levels. There's just going to be certain areas that are going to be better for certain circumstances. So when we're looking at Fibonacci levels to watch in the market, there's a lot of them that are favored by traders. The most common that you're going to find on your platforms are going to be like the 38.6 and the 61.8. These are going to be your two main ones that most platforms will have built into them. But you can usually go in and edit and add additional ones to it. Now I still keep to the very simple ones to begin with. I'll show you guys a little bit more detail here as we go forward, but the ones here in bold, these are the ones that are the core focus. So your 0% basically where you're starting from, 23.6, 38.2, 50%, 61.8, 76.4, and then 100%. And with most Fibonacci tools, which you can also use are the plus and negative levels. So things like negative 23.6 or positive 123.6. These are often used with retracement and extension levels, and they're combined with other visual cues such as momentum. And we're going to get there in just a few minutes. So a couple other favorite levels that you will find some traders use will be things like 27.2, 78.6. These are just based upon different ratios that take place within that Fibonacci sequence. That's what all of our Fibonacci numbers are based on. Some of them are just more popular than others. Like with moving averages, I like to stick to the basic ones, things like the 23.6, or like for moving averages, I'd use like a 20-period moving average, and just keep it really simple because these are the levels most traders are using to start with, and they're going to give you really good visual cues. So the ones that we use in trading are all based upon relationships that are within the numbers in that Fibonacci sequence. For example, 23.6 is based upon 0.236 ratio, which is found by dividing any number in that sequence by the number that is 3 places to the right. For example, 55 divided by 233. Also, another popular number, of course, is our 38.2. That is based upon dividing any number in the sequence by the number that is found 2 places to its right. For example, 34 divided by 89, that's going to give you approximately 38.2. So this ratio works after, I believe it's after the, what was it, the 13th number in this? No. I'm trying to remember here. It doesn't work with the first couple of numbers in the sequence, but basically everything after that point. I think it's the after 13. So using Fibonacci to strengthen your hand in the markets. Now that you guys know where those numbers come from, let's show you how traders apply that to the market. So first, we're going to look at a core continuation strategy. How many of you guys like to trade continuation strategies in the market? Things like bull flags, bear flags, cup with handles. A lot of you. I am sort of, I guess you could say I don't have like a major preference as far as the types of trends I trade. Always, I love to trade market pivots and reversals and things like that. And as we go through this, you're going to find that even though our base core setup that we're going to be looking at in today's class is based upon continuation strategies, the tools that I teach you are going to help allow you to time the market pivots as well and give you some of those greater pivot reversal trades. Basically, by helping you identify the correct support and resistance levels to use versus just when you look at a chart, there's so many types of support and resistance out there. There's things like previous highs, previous lows, previous zones of congestion. You've got Fibonacci levels, you've got moving averages, basically a whole slew of things that you can look at. And when you're using any tools in the market, the more of those that come together all at once, the stronger those support or resistance levels tend to be. But one of the key things that you have to pay attention to are momentum. I guess I should say two of the key things, momentum and trend placement. So when we're looking at continuation strategies, using Fibonacci, it can help you identify different target levels based upon where something is taking place in a trend. For example, if a trend is newer and you're looking at a continuation, basically the first or second wave of correction in a trend, then you can get some larger target levels. But when a trend becomes more extended, you might have to look for a tighter, closer target level. And Fibonacci can also help you there to help determine, okay, if I can't look for a full larger move, like some of the previous rallies I've seen, what do I look for? So we're going to be looking at the continuation strategies here to start with, and I'm going to show you differences in changing and adjusting target levels as we go forward. But just starting with the basics, let's go from the very beginning part of a trade, and that is entry timing. So when we're using Fibonacci, one of the tools that we can use is the Fibonacci retracement tool. Pretty much every trading platform out there is going to have a Fibonacci retracement tool. All of the trades that you guys see in today's class are live trades, and they are ones where pretty much the majority of them I've given in front of groups. So I like to pull those trades to use to show you that I'm not just looking at strategies and patterns that are happening in hindsight. These are things that we are talking about as they are unfolding long before they ever get to the target levels that I show you here. So we're going to start to begin with here. This is the NQ. This is a 2000 tick chart of 2018. And I give this class multiple times throughout the year. And so what I will do is I will pull trades from previous classes that were happening that week. And then I go and pull more recent stuff. So what you're going to see is over time how well the tools and techniques that I talk about today are going to apply and how you'll be able to continue to use them in the future. So a Fibonacci retracement tool is basically a tool that you're applying to an impulse move in the market. And it doesn't matter what time frame you trade on, it doesn't matter what security you trade, whether you're a futures trader, forex, stocks, options, it just doesn't matter. So we're going to be looking here first at an 8,000 tick on the NQ, and what we were looking at the time, or what I told my traders to look for at the time, was a continuation play on the NQ. And so the original impulse move that took place here was this rally off of lows. First of all, an impulse move, for those of you that are newer to trading, an impulse move is basically the primary directional swing of any security. And it's something where the market is moving average to faster than average momentum. So it's basically your strong bullish moves in the market. And they are fractal in nature, meaning that a larger impulse move, such as the one here, can have smaller ones. Like you can see this one has two major smaller ones, and then each of those actually has two as well. The market likes to trade in waves of two. In fact, I prefer to count waves of two over traditional Elliott school thought of waves of three, because I find that it just works so much better over time when I am thinking twos and twos and twos and twos. Maybe it just goes back to dancing, you know, you're growing up, learning your two-step. Well, the market likes to two-step, and it does it a lot. So when we are looking at Fibonacci retracement levels, we're also going to be using the two-step, meaning the best continuation patterns that are the most predictable are the ones that will have two waves of correction. When we're looking at Fibonacci levels for the correction, what we want to watch for are the most probable continuations will hold a correction point at that 50% level. So by holding that 50% level, what it does is that previous highs serve as a weaker level of resistance than they would if the market retraced more than 50% of that impulse move. So to draw a retracement on an impulse move, we're basically going from the low of the move to the high of the move. And that is in the case of an upswing. Reverse it if you're going in the case of a downswing. And that's going to project up these retracement levels. So notice here that momentum was pretty strong coming off of that high, which is marked at the 0% retracement. And it pulls back pretty sharply into that 50% level. Now, I want to think in terms of waves of two. If I only have one move to the downside in a corrective move, the odds are higher that a secondary correction can take place. It doesn't always happen, but the odds are higher that it will happen. So if you want to go and progress your trading, like I often work with traders to do, going from the higher probability strategies, and then once you've really gotten those down, then you can go into learning how to trade some of these other strategies that might not yield as much, or you might have to sit in them for longer to get your gains, but you can go and build onto them from that point. So with the two-wave pullback, the strongest continuation patterns we're going to see are going to be ones that hold that 50% level. A lot of times it might come into the 23.6 on the first low and then hit like the 38.2 the second time around. Sometimes it'll go into the 50% and then hit one of the higher levels up here. I generally prefer for the strongest breakouts that the first low hits a higher level support than the second low. So we're a little bit reversed here with that because our first low is lower than our second low. The reason for that is that it helps protect me against the possibility that this overall momentum could shift coming off of this low. So it just overall I find it's just a better setup, a better, stronger setup, but you're still going to have many, many that work like this where you have the lower first low and then the higher second low. So ideally what you then want to see at that point is a momentum shift to take place. Notice again, counting in waves of two, we got two moves down into that 38.2. That gives an initial setup trigger, but overall momentum hasn't really shifted a lot yet. But as it continues to hold that 38.2, you'll notice that this entire move here now begins to shift momentum, especially as compared to that original impulse move. So this shift in momentum is what helps establish this as a really strong buy zone. Combine that with things like the Fibonacci retracement levels, and you've got a strategy that is going to give you a pretty decent return compared to what you're risking. Now let's go look at this as far as looking at the reversal. So we've seen this a lot in the market over the last couple of months where, again, it's been those sets of twos. So the market's been two-stepping where we will have two steps up, two steps down. If it tries to go for the third one, there's a greater risk that the momentum will shift and you won't have as strong of a continuation. So here is another example where once again we pulled into the 50% point, and this time around we were looking for the short side. We were actually looking for the short side all the way back up on the 17th, but I'll show you why here in just a little bit and you'll understand why. Basically, on the reversal, once again, you get your bounce into the 50% level, and then it shifts momentum when it pulls back up into that 38.2. So we have a couple of key things all happening here at once. We have not only the Fibonacci that I've been showing you, but we also have momentum shifting, and we have a two-wave count. And often these smaller moves will even have two waves within them as well. Like you can see here, the two waves back up on October 22nd, even back here on October 16th or 15th, the two waves down. So those two steps help you with understanding where zones of support or resistance are most likely to hold. So when this comes up here to the 38.2% again, it's a really solid resistance level, just like when it came down into the 38.2% over here on the 15th. Notice though, it didn't fully take off at that point. And that's because the momentum here is still on the stronger side. It's basically average momentum at this point. And it takes the extra little shift at the very end that helps turn things around so that we finally get a bigger breakout. So we're basically putting a lot of things together here all at the same time. We're not relying upon Fibonacci by itself to initiate a trade. We're also looking at other factors that are going into the development of these trades. And this is where traders run into trouble when they're using indicators for trading, because a lot of systems that people are taught are based upon trading off of indicators, and they never learn how to read the underlying price development that is taking place in the market. And it's really, really important to understand pure price development in its own right without all of the additional indicators that are cluttering your charts and maybe make it too difficult to see that price action. If you talk to a lot of us that have been trading for a couple of decades or longer, you'll find many of us don't have a ton of things on our charts, and we can trade even without having any indicators because we understand the flow of the market. And that's what I want you guys to do as well. I want you to understand how the market breathes, basically. What is the cardiac rhythm of the market? And you can use tools like, your pacemaker and additional things to give you a feel for the market, but it's still under there beating whether you have those tools drawn on it or not, and this still has pattern and rhythm to it. So let's show you guys some additional examples here of using the Fibonacci. So here's our short. So the second technique we're going to look at is establishing a solid target level. Again, I'm going to keep things very simple for you. We'll look into adjusting target levels here next. But to begin with, you can use a tool called a Fibonacci extension to establish a target level on a breakout type of strategy. These can be used as well for reversal strategies, but they're in a little bit of a different context. What we're looking at for Fibonacci extensions is we are using a 3-point Fibonacci extension. Some of you might be familiar with 2-point ones. Basically, a 2-point extension is a retracement level that has those negative Fibonacci levels added to it. So you'll have like your 0 to 100%, but then you're going to have like negative 23.6, negative 38.2, extending past those levels. So when we're looking at Fibonacci extensions, one of the key traits that you guys will notice over time in the market is that not only does it like to move in waves of 2, but it also likes to move in measured waves of 2. So if you are trading a breakout or a continuation strategy, such as the one here, or even here or here on Google, as we're trading here just over the last couple of weeks, what you'll find is that you can often predict where that security is going to find support or resistance based upon looking at these measured moves. And a really simple tool to help you add these measured moves onto your chart is that Fibonacci 3-point extension. We're going to come back here on Google in a second. So here is an example of this where we're looking at the ES. This is a monthly time frame of the S&P 500. And as those of you know that follow me live, we were looking for reversal strategies, not only on the monthly time frame, but also on the daily time frame at both of these highs, because we were coming into these measured move resistance levels that were forming on the monthly time frame. There was a really steady uptrend back from 2011 into 2015. where it's basically coming out of this zone of congestion that lasted for a couple of years prior. It was a tilted zone of correction, but a correction zone nonetheless. It's almost about the same amount of time as we saw here on the current continuation breakout. And so even though momentum was picking up just a little bit, what often happens is that when the market still comes into that 100% target level, if momentum is increasing, even in circumstances it manages to go past that 100% level, the pace will often stall at that point. You'll start to see more back and forth action. So markets that continue higher with increased momentum, they'll still treat that 100% level as resistance, but then they'll just start to swing wider at that point. And usually go into like the 123.6, 138.2 as the next major resistance level. Why did I start there rather than an earlier point? That is a very good question. So the reason is because when you're looking at lows, you've got a low here, you've got a low here. If you're drawing like a trend line, like that. So what I'm doing is I'm looking and treating this as a zone of correction that started back in 2010. And we have basically a lot of that back and forth type of action. So I used this low because it's the last major low before this steadier trend begins. So you will see bases and periods of congestion that will be tilted like this. So you'll have an impulse move over here, and then you'll have the breakout over here. So when you're looking at the breakout target level on that next move, I'm going to be going and using this level to extend to do my measured move. There's a lot more advanced stuff that goes into that. Not tricky advanced stuff, just beyond the scope of what we have time to cover here today. But what you will find is that using these measured moves is going to help you identify those major levels of resistance. So the same reasoning was behind why we began to target short strategies heading into this fall, because once again, we had that same set of measured moves. And comes up into the slightly higher high, momentum is shifting overall, all together working to create this stronger reversal pattern that is forming on the overall market. We'll look at the NASDAQ, which hit and held a little bit faster here in just a little bit. But here's another example, again, live. This is a continuation trade that we had on the Dow on the 1,000 tick. And you'll notice it looks very similar to what was happening on that S&P 500 on the weekly chart. We had the initial swing up, little bit of a correction, it's nothing major, and then the breakout. So originally, what I was looking for was, of course, the 100% target. You'll notice this goes a little bit past that target level. Who can tell me why they think it manages to break past that target level eventually? So here's the 100% level right here. And as you can see, it reacts off of that level just as it does the 61.8, just as it does the 76.4. Exactly, Pat. Exactly. It's momentum. So when this breaks out here, the momentum on this move is stronger than the overall momentum of the impulse move that goes into the breakout. We're going to come back to this, but this became a little bit of a tricky point in here because the momentum was nice and strong into 61.8, and then it started to shift a little bit. So that can make the probability of pushing past that 100% level with the increased momentum a little bit more difficult. So instead of trying to go and hold for a target level past the 100%, we take off part of the position at that level just to help protect us if in case this goes into some other shift in momentum like that. So your most probable target level is going to be the 100% level, but there's going to be additional traits that will affect whether it's going to fall short of that target level or if it has a greater chance that it might try to push through it for a little bit more so you can squeeze a little bit more out of your trades. So here is that continuation trade, and here's the 3-point Fibonacci extension that's added onto it and how we draw it. Basically, I'm going from the low of the first impulse move to the high, and then this correction here, this is where things can get a little bit tricky. So if it looks like a kind of like a messy little mushy level, just use the absolute high and the absolute low of the congestion. If you have a two-wave correction in the middle, use the last low from the second wave of correction. And here you can see where those different levels of resistance helped identify zones where you can get reactionary moves. So if you're a scalper and you're not wanting to hold through any corrective type of moves, Fibonacci levels can help you identify those levels that are going to stall the market. So the third technique we touched on just a little bit here, and that's adjusting those target points based on momentum. So here's the NASDAQ. And this is a continuation play that we were looking at in the NASDAQ, where we were then, or I guess I should say, I say we because I teach and work with traders a lot live during the markets. But here's what I was looking at on the NASDAQ as we went into those highs at the end of the summer. We had a momentum swing here. So if you look at that action, notice that the pullback here goes to the 61.8% level. What that tells me right away is that not only is a previous high going to serve as a stronger resistance zone, but it can impact an entire move that can bounce off of that support. So it has a much harder chance of trying to go for a 100% measured move based upon this rally as a continuation type of move. I'm still thinking in terms of waves of two though. So if you wanted to look at this as the two-wave correction, just like we were looking at the patterns before, in the ones that worked out where they went further to 100% target level, they were able to hold that 50% level. Now this holds the 38.2 on the second correction, but what it does is it actually creates more of a micro trend type of move. You've got a lower high here and a higher low, shorter upswing. So instead of looking for this bigger swing as a target level, I dropped down and used the smaller movement instead. So I went and took that smaller impulse move here to the correction of where the momentum started to pick up. And then we used that level as our target. So we were projecting, or I was projecting, this target level all the way back here, all the way back at like that second week of August before we had even completely corrected. We knew that the odds were going to be higher, that they were going to go for a higher high, and where that higher high was. This is all using momentum, trend placement, and the Fibonacci tools, and just understanding underlying pure price action. The pattern that is at play here is one that I call a 2T, and that pattern consists of a move into a high, a pullback, a move that goes a little bit short of that previous high, another pullback, and then the measured move here to here, and that triggers the short zone. For those of you who've been following the markets a lot recently, we have seen this pattern form a lot. So let's go and look at a little bit more of the details here on this. Here's the target zone. Again, this helped us time the pivots off of those highs as well as target levels for the continuation move. So this is how these Fibonacci levels can help you not only put target levels on a continuation play, but also time where the pivots and market reversals can happen. So let's look again at a little bit of a more recent example. This is DIA, or diamonds here. And originally going into this move off of the highs, what I told my traders was that I would be looking for a stronger correction than we had seen back at the beginning of the year, where basically it held that low and then managed to come back up. And I said, okay, let's look for a measured 100% target on the downside. Now what you'll see on the diamonds is that it didn't quite get there. So it formed something very similar to what we saw happening on the NASDAQ, where it came down. It wasn't quite just short of this previous low, but you'll see this corrective move up and the measured move here. So this helped time intraday a target level for a gap closure, but the larger trend placement was still more on the bearish side. So these short setups also led to intraday bounces by using those measured moves and using that same type of skill or technique, indicator, whatever you want to call it. And we also were still able to time the low in here as well, because instead of looking at the full 100% extension, what you will see is that these Fibonacci levels are still holding. So after our initial two waves down, we had a nice series where momentum continued to shift. Every single low held each of those Fibonacci extension levels. So it was really great to help time intraday pivots back and forth throughout that week and help us understand where that absolute target level is going to be. Because when momentum is still average, even if it is not as strong as the original move, if the momentum is still average, the typical target zone that I will look for will be that 76.4%. If this is slower than average, meaning if you look at most of the V pivots back and forth in the past, if this is slower than average, then I'm going to tighten it up and maybe look for 61.8% or sometimes even 50% as target levels, just because of those momentum shifts. But in general, if the continuation still has average momentum, you can still look for 76.4 and expect that a good 90% of the time or more, it's going to hit that absolute 76.4% level. If the momentum is the same as over here, then you have a really good shot of going for that 100% level. One of the zones that people will get tricked at, though, is the momentum will have the same move right here. It'll go down to like maybe 50% or 61.8, and then it will pull back up. And so then they're left wondering, what on earth is going on? Toni said, if the momentum is the same, I should be able to get that 100% extension. Well, you know what happens? This is only the first bounce. So it tries to go for a second bounce, and then you get the 100% extension here compared to here. And it treats this as a two-wave correction that's just tilted. Remember that drawing that I showed you guys at the very beginning, where you're looking at the heads and they're each facing different directions? Well, that's what the tilted continuations can look like. So you might have a strong momentum continuation, but it still falls short of the 100%. And a lot of times that's because it has room to go and do that 100% after a second correction. This is going to be the case when a trend is in the newer stages of a trend or in the middle stages of a trend. If a trend is getting more exhausted, then it's going to have a harder chance of getting those 100% levels. But that's a class for another day. So here's another example showing us how momentum shifts over time. This is a tick chart. It's the NQ 1000 tick chart, and this is a short pattern that I traded in the very early morning hours, and we have the two-wave correction. This time the second correction goes a little bit higher than the first. This goes to 23.6. This comes into more of the 38.2% zone. Here's our two-wave continuation, and you'll notice that momentum on this tick chart looks pretty comparable, right? So 100% is a very reasonable target based upon that, but it goes past that 100% level. Why does it go past the 100% level? Because while the tick chart has comparable momentum, the time frame chart has faster than average momentum. So when we look at the 5-minute chart of the NQ compared to the 1,000 tick chart of the NQ at the same time, momentum was much stronger on the 5-minute chart. And a lot of futures traders will miss this because they'll be paying attention to just one or the other and not combine them both. So it's really important to keep in mind not just what is happening on the smaller time frame that you might be looking at, but also look at some of the bigger picture as well. And that can help you with making sure that you're adjusting your target levels properly and you're getting as much out of the trade as you possibly can. So with an increase in momentum, you're usually able to get more than that 100% target. So here is a move coming off of highs. I drew the extension level based upon the absolute high, which was up here in the morning. But really you're dealing with a trend that goes like this, and then the momentum is dramatically increasing. So this was one of a gap trade on PayPal that we were following live, and I gave it to watch for a breakdown. I gave it on this day, actually, to watch for a breakdown. And it triggered the next day, or later on in the day. And what you'll see is that here's the extension, here's the short trigger, here's that 100% target level. But if you went down to a smaller time frame, you would see that the breakdown itself actually has two waves of continuation. There's a strong momentum move, a little bit of congestion, and then the continuation. So you can still use that same technique, but then apply it to that smaller measured move. And that's going to give you that target level. So a couple of you were asking, hey, where are we going to go from here on the Dow, the Spider, the Qs? Well, here's a chart that I grabbed today. What do you guys think based upon this chart? What do you think would happen? Now, I know we're a little bit past this here now, but do you think there's a little bit more room to wiggle around at the lows, or do you think we're done? Here's where we see how many people are still paying attention. Right. So we have wiggle room here. This is still acting as a magnet down at this 100% extension. So momentum here so far picked up a little bit faster to begin with, and then it's kind of slowed with this congestion, but there's still room for this to pull to the downside. So we want to use caution on upside plays at this point. They're going to be more of the scalpish types of moves intraday. I would not be getting into longer term plays, watching for bigger multiple day bounces at this level, because the risk is just much higher that if I try to do that, and especially if I use like wider stops, I could get pulled out really easy. And so the easiest momentum right now is still going to be on the downside. So I want to show you guys something here on COL today, but I'm going to go back to it. So first, what I want to show you is the next step. So here's what I have to offer you guys today. Everybody's offering you something, right? So you've got a lot of thinking to do at the end of the day, what kind of education you want going forward. And I know basically everybody that TradeThirsty puts together, we are professionals. We've been doing this for a very long time. And we all have our own unique takes on things. But when you talk to all of us, you're going to find that we also have a lot in common simply because we've been doing this for so long. So what I like to do and what my niche here in with helping you guys understand the markets better is teaching you how to use some of the tools and techniques and the market analysis that I myself use in the markets. I use the mantra of keep things simple, stupid. So I don't want to go into something that is really difficult to follow. I do not give you a buy here, sell here type of service. I give you, hey, there's a buy here. Let's understand why. What would we use for target levels? Why would those be used for target levels? Okay, so this isn't following through like we need it to. How do we adjust this to get the most out of the trade? I want you guys to understand your trades basically. So the next step that I have available for you is a course that is called the Top 3 Strategies Using Fibonacci. what this course is it goes through all of the Fibonacci tools that I recommend using and how to use them. Not just the retracement and extension levels, but also things like Fibonacci fans and time extensions, which help with understanding the time development aspects of a trade, which are really just as important as all of the other things that I've talked about here. So this course, it was meant to be a 4-week course, and it ended up being a 6-week course where there's a kickoff session, tells you how to use the course, what we're going to be doing. Weeks 1 through 4 go in first using the tools, how to identify the tools, get to know your tools. Week 1 goes into identifying initial continuation patterns of brand new trends. So if something is just hitting a resistance or support level, maybe you missed that absolute pivot, but you're wanting to know, is this something that can offer continuation of this trend, or do I just need to pass on it? That's what week 1 does, and it tells you how to pinpoint, verify your entries using not just the Fibonacci tools we talked about here today, but also, again, additional things. We talk about time development. We talk about basically everything that goes into the strategies, and including trade management, which is probably one of the most important aspects of trades. So week 2, I look at how do you know if this trend is going to continue and how to play continuation trend plays within that trend. So recognizing the different points in a trend where there's still room to keep that trend going. Going past like the very simple concept we talked about today with the measured moves, but getting into even more detail on which of those really do go farther. Because if you look at any chart, you're going to see it's really easy to pick out measured moves. It's not as easy when you were looking at trends that maybe those measured moves just aren't as obvious. So that's what week 2 does. Well, it's week 3, but it's the second strategy session. And then the final session, week 4, talks about trading pure pivots. What can you do to identify those absolute highs and lows in the market? And you guys that follow me live, you will see me do this all of the time, where I can pivot, give you those pivot points at the exact times that they hit. And that is what we look at in that next week. And then I also give everybody a final live session that is now recorded that we looked at the market as it was unfolding that day. So it's that additional bonus session to show everyone how to apply the tools based upon what was happening right then in the market. That's what I'm going to show you here too. I showed you guys that on the Dow, but I want to give you an example on COL, because COL was something that I gap traded this morning. Like I said, I always want you to see what is happening right now versus what is happening in the past, so you can put all that together. You've heard me talk about the live sessions I do, the live trading I do, the live training I do. That is part of my League of Traders. So I ran a live trading room for about 12 years, and you get really burnt out when you have to be here from dawn till dusk and you have kids. So I stepped back to doing more of the courses and workshops and things like that. But in recent years, I've added back in a live training portion so that you guys can see how the market unfolds live. You can watch that live market analysis and see how I apply all of those things that I teach you in the workshops. So it's not just, here's the workshop, take it, bye, good luck, I'll see you down the road. It's take this workshop, go through the workshop, come in, attend the live classes where you can see it applied every couple of days in the market. I was going to say every day, but we meet 4 days a week. We meet on Mondays for Mentor Monday, which is basically each Mentor Monday session has a class like this where we focus upon one major aspect in the market. And then on Tuesdays and Thursdays, that is when we have our live trading room. That's for a couple of hours every Tuesday and Thursday. I also do text alerts and things like that throughout the week, things like, hey, here's a video, or here's something I'm watching. And There's additional videos, that sort of stuff as well. I also have, for those of you that are a NinjaTrader, I have an indicator that is free for those of you that pick up the course that will give you those Fibonacci fans and Fibonacci arcs, and allows you to set alerts based upon them, as well as you can even trade based upon those indicators. So that is something that's a free download for those of you that are NinjaTrader users as well, because NinjaTrader does not have things like Fibonacci fans built into it, which is one of the main tools that I do use in my trading. So you need to go to tonyhansen.com/go to pick that up. And right now it is $297. League of Trader membership alone is $97 a month. So you're going to get that free for a month. I don't do an auto renewal for those of you that take the course, although I know most of the people go in to renew it anyway, because they want the continuing ongoing live education. And it's also a great community. I read everybody's comments, so we really get to know each other, and it's just fun to hang out with you guys throughout the week. So go to tonyhansen.com/go to learn a bit more about that and pick up that course. And then I'm going to show you that COL I promised you, since we got a couple minutes, and I'll take some questions as well. So COL, like I said earlier, this was a gap play that I had this morning. Here you can see my fans on here as well. It actually helps with timing the continuation. I need to show you guys first off what was happening on the daily chart on COL. So let me show you the daily over here. So COL is a gap play this morning. We are still kind of in earnings season. So a lot of securities will be gapping based upon earnings, and then you've got like additional news, buyouts, all of that sort of thing. You'll notice right away when COL opened here around 140 this morning that it was coming in on previous highs, but it still hadn't quite gotten there. This is something I usually am not as excited about as a swing trade potential, with a gap and then holding part of it for a swing trade, but it's still really good for day trading strategies. And it's, again, focusing upon those two wave moves. So just using the very basic techniques that we talked about this morning, or I guess it's afternoon for a lot of you now, you've got the retracement. So you can see how that helped me time my initial entry. Let me put this up here. Right here is the 50% retracement. Let me grab my pen and show that to you. Usually when I keep Fibonacci levels on my own charts, I keep them really dim and pale because I don't want them detracting from what is happening in the overall price action. So you can see, again, first correction, second correction, and this gave me my initial trigger. Then for target levels, I used this two-wave measured move as a target level. It also corresponded to the negative 76.4 Fibonacci extension when you're using a 2-point extension with just a retracement. And you'll notice at that point, even though COL continued to move higher, that level stalled the security. So this measured move here, 100%, here to here, stalled that move. And even though it continued to creep low or higher, it shifted the momentum of that move. So that is something that you can recognize when you have something that's still moving at a stronger than average momentum into a resistance level. So the stronger than average momentum gives you the probability of some higher highs. It also helps identify where that momentum can shift. Same thing over here. So this gave me another trade. You guys saw it with the fans earlier, where I had the two-wave measured move for the correction, two waves down, even two waves up here. Technically, this hit the 76.4% fan, and that is where you can begin to build a position. But I like to use an additional shift in momentum to just greater guarantee my probability, especially if something is rounding off at highs. So this gave me a secondary opportunity here, where again, I placed a target level looking for a two-wave continued measured move. Now, in this case, I took most of the position off here because it's a little bit slower momentum than over here. So even though I know, with this smaller move, there's still a chance it can go for a slightly higher high, the odds decrease that that's going to happen because this is an average move versus a stronger than average move. So it made the probability of a higher high less than it did over here. So let me take a couple of your questions here. And you guys, if you, even if you scroll over, I was getting ready for this class here, so I didn't do anything with this later on, but you can even see like recognizing when you get bounces for target levels when you go and reverse strategies. Let me clear that there. When you reverse the strategy, this was even just a slower move here. This was even 100% extension on the downside. Erase this one. So you even had the 100% extension here on the downside to serve as support for this breakdown too. So really you can apply these back and forth no matter which way you're looking at the market. It's a really great tool. The link says 97, not 297. Oh my gosh, you guys. Okay, well I guess you get an even better bonus here. A couple of you guys pointed that out. Hey, usually for these classes, it is $297. So I guess Jeanette and the gang decided to give you an even better deal. And it is not updated from the live session from the expo. So you can pick up the entire course, hey, for $97. We'll have to say, thank you, Jeanette. She should be coming on here any second, actually. All right, so
I'm right here listening, going, what? What did she
Jeanette,
say?
You just gave them an extra $200 off the course. They are.
Look, I am not even trying to do that
Christmas
over here,
cards.
and so, but we will certainly honor it. So if we don't go in there and get it, they're insane. I got you, Toni. I got you.
So basically what you guys are doing is you're just paying for a month of League of Traders and you're getting this entire course by itself. So that's awesome for you, right? Thank you, Jeanette. Happy Black Friday, everybody. All right, well, I know my time is up. You know what? If you shoot questions over to the gang over at TradeThirsty, they will make sure that they get them over to me. So if you have any other questions, just let me know. I tried to answer a lot of them as I was going through. So as you guys were popping them up, I worked them into the conversation. So thank you, everyone, for letting me join you here today from the beautiful Las Vegas Strip, and wherever you are in the world, I hope you have a wonderful remainder of your week and an awesome weekend. Thanks again, and thank you, Jeanette.
I know, right? Okay. I'll make it up to you, Toni. I promise.
That's okay. I love all of these people, and I know that they're going to ask awesome questions in League of Traders, and they will love the community. So I look forward to getting to know all of you even better.
Got you. All right, guys. I'm going to take back the power from Toni. And y'all better go grab that deal while it's still there, because $97 was not the plan, but
not at all.
but it's there now. It's out there, and so lucky everybody. This is like when you walk into the store and you think that the flat screen is going to be $9.97, and they mispriced it, and it's $2.97, and you're like, yeah. Hell yeah. All right, Toni, I'm going to turn you off and then pick back up.
All right. Take care, everyone. Enjoy the rest of your Trade Thirsty Thanksgiving.